we continue today, it's portfolio theory. So, are you zooming in? You always zoom in the pen, right? So, portfolio theory, this is part 2 of the textbook. Part 2 of the textbook. Now, cameraman, let's zoom in big time, deep into this textbook, Essentials of Investment by, what is it? Bodie, Kane, Bodie, Kane, and Marcus. Zoom in a lot, right? Is it zooming? Alright, so Bodie, Kane, and today we are looking at chapter 5. So, part 2, chapter 5, we begin, and for the next maybe 3 or 4 lectures, we will be, maybe even 5 lectures we'll be doing with portfolio theory. So, chapter 5, we begin with 5.1, which is rates of return. Come on guys, you want each penalty points? A couple? Rates of return. Alright, so first of all is holding period. Holding period is simply the period of time for which an investor held an investment. So, holding period is associated with time. An example of holding period will be 1 day, 1 week, 3 years, 7 years and 2 months, 12 years and 5 months, whatever. Out of holding period, you get the concept of holding period return. And this is the total or cumulative return which you received throughout the complete or the whole period. And it has a strict definition. The 3 signs here mean by definition. So, you have ending price, and then you subtract beginning price. Ending price is the price of the asset at the end of the period for which the asset was sold. Beginning price is the same as purchase price. This is the price that the asset was purchased for at the beginning of the period. And then we draw the line, and if we're going to be making returns, we need to normalize, and we normalize by the beginning price. In other words, we take the last price, and we take the initial price, then we divide by the initial price. Here, we assume that there has been no income in the meantime. If there is income, we continue and say plus income. Remember, we can't just say cash. For some assets, the income will be dividends, right? These are stocks. For other assets, will be coupon. For real estate, it will be rent. So, whatever the income was, and the name of the income depends strictly on the asset class. Alright? So, this is the holding period return. Now, next concept is rate of return. And as we started so far, rate of return actually is about normalized HDR. In other words, you are normalizing the return, and the normalization is standard for 1 year. In other words, if you just got from your investment 20%, is 20% a lot or a little? Well, if you got it for 1 year, presumably you got a 20% annual return. If you got it for 5 years, you barely got 4% or less than 4%. So the rate of return gives you the return which is average or normalized to 1 year. Okay, now two more concepts which are not very directly related to portfolio theory now, but which are present. One is so-called dividend yield. And dividend yield is simply the dividend for a particular period, usually dividends over 1 year, the total cumulative dividends over 1 year. Sometimes you may have 4 quarterly dividends, and then divided by the price. And usually the price is either the price at the beginning of the period or the purchase price if you bought it before. So if you bought it 3 years ago, you can compute dividend yield, which is based on your purchase price from 3 years ago, or you can compute the current dividend yield. The current dividend yield is at the beginning of the period. So you accumulate the dividends over, let's say, the four quarters for 1 year, and then you divide by the initial price at the beginning of the year. Okay, so that's the current dividend yield. All right. Another concept is that of capital gains. And capital gains is simply selling price minus purchase price. The selling price is effectively the same as ending price. And the purchase price is the same as beginning price. So all that I'm saying here is that the capital gains is the increase in the price of an asset. The simplest example that you can possibly get is you bought a house for 100,000. The current price, or you sold it for 120, your capital gains will be 20,000. This is shockingly simple concept. Alright, so now let's use only this part of the board over here. Now let's do the following. Measuring investment returns. In other words, if you had an investment for 6 months or for 3 years, how are you going to get the rate of return? In other words, it's easy to compute the HBR. It's easy to compute the return for the whole period. You held it for 3 years, your house, from 100,000 to 120,000. So the question is, if you held it for 3 years, what's the annual return? So, simplest way to say is, hey, we got 20%, we divide, well, there's no summation. You got 20% over 3 years, you divide by 3 years, well, let's make it 21%. You divide by 3 years, you get a 7% annual, and that is a simple average. Of course, the simple average provides a bias because it does not account for compounding. So, if you account for compounding, now you have to take, instead of simple average, you have to take a geometric average. In a geometric average, you have 21. In other words, you take the total holding period return, and then you raise it to the power of 3. Well, it's not going to be 3, it's going to be 1/3. It's going to be 1/3. So let's explain this process. If your return is 10%, 10% return translates into 1.1 total return. So this is net return, so this becomes total return. 1.1 simply means that if you invested originally 1,000, with a 10% return, you're going to be getting 1,100. So 1.1 simply represents the ratio of the end price divided by the original or beginning price. So 1.1 is a 1-year return. If you want to compute the return for 2 years, then you take 1.1 and raise it to the power of 2. Now your return is for 2 years. So this is a 2-year return. So for 1 year, you have 1.1 and you raise this to the power of 1. For 2 years, you get 1.1 to the power of 2, okay? For 3 years, you get 1.1 to the power of 3. So, when you have a 1-year return of 10%, the 2-year return becomes 1.1 to the power of 2, and let's just say 10-year return is 1.1 to the power of 10. So this is converting 1 year to, let's say, 5 years. But now the question that we're trying to do is the exact opposite. If you have 5 years, how do you convert into 1 year? So now we have the opposite problem. And then, if you say, for example, you have a return of X for about 3 years, and let's not say X, let's say 1.21. This is what you get for 3 years. Then you have equals X to the power of 3, right? I'm just using the same one here. Alright? So, if we know that for 3 years we got 1.21, and then the question is, what is the annual? Well, the annual is just X to the power of 3. And now, X is simply, we raise to what power now?
1 over 3.
Yes, 1 over 3. So, we do 121. 1 over 3 here, and then 3 times 1 over 3, right? We raise to the power of 1 over 3 so that this cancels, and X equals 1.1 to the power of a third, alright? So,
is it geometric average?
Yes, and that is just called a geometric average. So, this X equals 1.21 raised to the power of 1/3 is actually this thing over here, alright? So this is a geometric average. And geometric averages account for compounding. Simple averages do not account for compounding, and geometric averages do. So, for a relatively long period of time, 3 years, of course, 10 years, 20 years, 50 years, 100 years, you must definitely use geometric averages. So for a period which is close to 1 year, possibly 2 years, simple averages will be good approximates. But for a lot of years, not a question.
The gain is constant.
Yes, that's okay, so that's the next thing. So a built-in assumption for an average is that the gain, but again, we don't say the gain. Gain has a strict meaning. The return is constant. In other words, this computation assumes that the return from year to year to year has been constant. At least this is the assumption but actually this is what you want to get in some real practical questions. A hedge fund or any other mutual fund will simply tell you over the last 5 years we have generated a total return of 50%. So their annual return is about 8, maybe 9%. We gotta do this 1.5, and then we have to compute it to the power of 1/5. So if anyone has a calculator, can compute it, but it's not a big deal. We don't need to do the elementary math over here. So the idea is that what you want to do is take the average for these 5 years. Of course, the simple average will be 10%, and 10% will be overstating significantly the return. More questions? Any? All right, let's see what else we have. Oh, we have, let's wipe this off here. So what we have is a third method, which is probably the most sophisticated method. So method number 1 was simple average. Method number 2 is geometric average. And method number 3 is dollar weighted return. Dollar weighted return. This is the third method. Dollar weighted return actually is the return which also accounts for income during the period. In other words, whether you got for 5 years you were holding it, whether you got the dividend at the end of the first year or at the end of the 4th year, there is a world of difference. And this weighting is based. Have you guys studied internal rate of return?
Internal rate of return.
Yes, so this is actually exactly the same as the internal rate of return for a project. Internal rate of return for a project. Now, let's try to outline what was internal rate of return for a project. You have an initial cash flow, and the cash flow is at period 0. So, cash flow in 0, right? And the cash flow in 0, we usually have it in negative, right? Usually that's a cash outflow. So, negative sign means outflow. Then you have a cash flow in period 1 plus cash flow in period 1 plus cash flow in period 2 plus dot 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 cash flow. Let's just make them 5 periods, right? So what we have so far, and this has to be what? What do we do with internal rates of return?
Discount.
Oh, we have to discount it. And after we discount it, if we're going to be getting the return, we have to somehow normalize it to something. So the normalization is 0. So cash flow 0, we discount to nothing. The current period is nothing. Cash flow 1, we say 1 plus x, correct? Yes, to the power of 1. Cash flow 2 becomes 1 plus x to the power of 2. And dot 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 becomes 1 plus x to the power of 5. So, cash flow 0 will be, let's try this. Cash flow 0 is the same as the purchase price of the asset, right? This is what we actually purchased it. So, this is purchase price. I'm going to do here a little trick, which you guys can't do in your notebooks. I'm going to say plus dot 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 CFN. That will be the last one. N will be the very last one. It could be 3, it could be 7, it could be 17. Plus 1 over x to the power of n. Excellent. So cash flow 0 is the purchase price. Now we say cash flow n will be the sale price. Sale price, again, is the same as ending price, and sometimes they even call it the liquidation price. So liquidation is the process of converting an asset to cash. So this is the sale price. So we have all of this stuff, and this stuff equals to 0, right? And now what do? We take the cash flow, which is with a sign to minus, and move it over to the other side. So I wipe this off to minimize on this. We just say cash flow 0. In other words, you equate the initial cash flow and possibly all out cash outflows you put on the one side. In this particular case, you have only one cash outflow. And then you take all cash inflows, discounted for the period of return. So if you got it in the first period, you discount it for your return to the power of 1. Put it in the second period, return power 2, and so forth. So now what we get is that this value x here that solves this equation is and that's simply the definition, internal rate of return. And I always think of dollar-weighted returns as internal rate of return because it's a very nice, very intuitive concept. Everyone knows and everyone understands. Dollar-weighted return is actually a little bit confusing, but when you say it's the IRR, then it is not. Usually you want to use IRR especially when you have dividends or significant intermediate income. In other words, if the income between the purchase price and the sale price was minimal, then you can just use geometric averages or other approximations. But as long as you have significant income in between, or significant in this particular case, just call them cash flows in general, then you want to use IRR. And especially you want to use them when the cash flows are not only significant but also uneven. In other words, they have big chunks either early or very late in the process. Alright, so this ends the part on measurement. And now we have conventions for quoting.
Sir?
Yeah?
What if after you purchase more stuff?
If you purchase more stuff, yes, if you purchase more stuff, it's the very same story. You add it over here. So, suppose, okay, question. What if we purchase more stuff? Let me still wipe this off and I'll answer your question. Here's how this will work. So, I'm wiping this off. So suppose you purchase more stuff. Could be more of the same stuff. Stock X could be some other stuff. Real estate doesn't matter. We use, let me clean this nicely. We use the very same trick. Cash flow 1, so now becomes cash flow for asset X1. And underneath you say plus cash flow for asset Y, period 1. Divided 1 over x to the power of 1 plus.
Well, this is a cash outflow.
Right. If it's a cash outflow,
we move it to the other side.
We move it on the other side. So if it's a cash outflow, and for example, cash outflow occurred in period 2, then you just say cash flow in period 2. The asset now is Y.
We still discount it.
You will still discount it for 2, 1 plus x to the power of 2. And here, because we bought it in period 2, we will be getting some cash flows from period 3. You begin from cash flow 3, power 3, cash flow 4, 1 plus x to the power of 4, etc., etc. And now you sum the cash flows here, discounted cash flow here, and discounted cash flow there. So you draw the line, and when you sum up, what you get underneath is 1 plus x to the power of 1, and you have cash flow 1. And then you have x plus y. In other words, cash flow 1 for asset x plus cash flow 1 for asset y. And then plus cash flow 2, which is the cash flow of asset x plus the cash flow of asset y.
But here you're assuming that there is an equal internal rate of return.
Yes, right. The internal rate of return is one variable. So if you have one asset, you assume it's the same. If you have two assets, you are using the IRR to compute the same return for both assets. So you're effectively averaging. If one was returning you 5 and another one was returning 9, it will average around 7 if they had more or less equal weights, 50-50%. Of course, if the higher return had 90% weight and the lower return had 10% weight, the average will be higher than that, will be closer to 7 instead of closer to 5. So again, what we're trying to do is exactly this. We're trying to get the actual return. What was the average for these two assets? If you have a portfolio of 10 assets, you actually want to get what is my total return for the portfolio. And actually it's going to be total, but still average return. One asset gave you 1, another asset gave you 12, another asset gave you 3, and your average return for the whole portfolio is 7. That's the question. What we're trying to do is effectively average. This is the objective of what you're trying to do. You're not trying to decompose the portfolio for each piece. You're trying to put one portfolio together and find for the whole portfolio. Alright, so now we're moving to the next topic of how do they actually report for returns. In other words, one of the ideas is that when, for example, brokers or some other salesmen are selling you a fund, mutual fund, they like to advertise the returns, right? I mean, funds are so homogeneous that the only thing that really matters is the return. And this is what they always tell you. Of course, that's not true. What really matters is the return for the risk that you're assuming. That's a different story. But sales techniques in general usually emphasize some way of over-reporting the returns. So usually salespeople actually like to say, oh, this is giving you a great return and whatnot. So usually they use statistical tricks to fool you about the real return. So there has been over the years standards which have been imposed on them about fair reporting or fair lending practices when you're borrowing a loan, or requirements for mutual funds to report just the way it is. So they have, and let's try to have here three measures which have been dominating. The first one is called APR. If you're going to be, for example, having a credit card, you're borrowing on a credit card, usually they'll say for the credit card that it has an APR of 17% or an APR of 19%. The second measure will be EAR, and the third measure will be APY. So these are the three most popular, and in the United States you actually have a law that for many loans they must report to you the APR. And the APR includes not only the returns or the interest that you got to be paying, but also includes commissions, taxes, management fees, and so forth. So what is APR? An APR is
annual percentage rate.
right, annual percentage rate. So what is EAR? Effective. Have you done this the previous semester?
Yes.
The effective percentage, percentage rate, and APY is, well, what's the textbook saying? Page 131. Annual percentage yield. Annual percentage yield. So what is characteristic for the first one is that it uses simple averaging, especially for month to month to month. The effective is using compound. This is running out. The effective is using compound. And finally, the APY is simply equivalent to the EAR. In other words, professionals in the business usually want to call it annual percentage yield instead of annual percentage rate. And the annual percentage yield is the same as the effective annual rate, which means that they will be reporting the two most common in the business will be annual percentage rate and annual percentage yield. And the difference is that the rate uses simple averaging or discounting or compounding depending on... You guys, okay, let's try this. Let's clarify between compounding and discounting. What is the difference? Compounding makes...
It considers the
No, it takes present values and converts them to future values. And discounting is the opposite. It takes future values, so let's use only one arrow here. Future cash flows and converts them to present. Again, both compounding can be simple and compound, and both discounting, well, discounting is almost always compound. In other words, for each period, we account separately for the interest. Alright, so that's fairly straightforward. Let's move on, and we're done with section 1. Let's move on to section 2. So, section 2 begins the heart of portfolio theory. So we have 5.2, and this is risk and risk premiums. Risk and risk premiums. We have a number of basic concepts. The first basic concept is that of uncertainty. Now, uncertainty is usually understood as two very different ways, but let's clarify one step more sophisticated and provide the difference between uncertainty and risk. And the more general, advanced way to think about it is that for a risk, you can estimate probabilities. That's the key. The key is estimating probabilities. And for uncertainty, you cannot estimate probabilities. Cannot estimate probabilities. A different way of saying this is that when you have the distribution of the returns, then you have risk. When you don't have the distribution of returns and you cannot estimate the distribution of returns, you have uncertainty. And a lot of economists and a lot of finance guys do not want to get into the difference, the tricky difference between the two, so sometimes they just use uncertainty and risk as the same thing. But the answer is no, it's not the same thing. With the credit crisis, especially over the last month, October of 2008, people suddenly realized that risk is not the problem. People realized that, yes, markets have become a lot more risky, but they realized something completely different. Markets have become a lot more uncertain in the sense that you can't even estimate anymore what the probabilities are of different things. So before you had some distributions holding from the past, and you believed that you had some distributions and expected outcomes, or the distribution of the expected outcome. Suddenly, with a credit crisis and freezing markets and liquidity evaporating, they realize that, oh, we can't even estimate what the probabilities are. We don't even have prices. In other words, you have an asset, you try to sell the asset, and there is no buyer on the other side. Well, if there is no market, and if there is no price, and if there is no quotation, of course, you can't even see what the distribution could possibly be. So that's one big difference. Now, how do we... So finance, now you gotta understand, as more or less any other science, is totally helpless and has no tools whatsoever to deal with uncertainty. So finance guys, it's just very easy to say, well, uncertainty doesn't really exist, or uncertainty is the same as risk, but of course it's not. So uncertainty is usually mentioned, one sentence, possibly two, and then it's forgotten as if it doesn't exist, and textbooks continue always with risk, okay? Because risk is something for which you can estimate the probability and have a distribution. So, how do we do this? And we do this with so-called scenarios. So, scenario essentially is an outcome. Scenario is more or less synonymous with outcome. I think there was some... yes, so scenario is actually, let's call it, at least the textbook says, possible outcome. So, scenario, you have the classic example will be the good scenario, or the good outcome, and the bad outcome. In business, they prefer to use a different concept. They prefer to use the optimistic scenario, the expected scenario, and the pessimistic scenario. So, in a scenario analysis, what you try to do is define all possible outcomes. Outcome A, outcome B, outcome C, D, etc., maybe X and Y. So you outline all possible outcomes, and in order to provide an estimate of the risk, you must, and that's the key, that risk is associated, we did this very early in this course, is that risk is associated with probabilities. So, for scenario analysis, what you need to do is for each possible outcome, you have to assign, which is the same as evaluate or estimate, the probability. Let's say 1% here. Next one will be 2%. Next one will be 5%. Next one will be 7%. And again, 2%, 1%. I'm assigning some probabilities. And if the scenario is to be complete or proper, the probabilities must add up to 1. The sum of probabilities must add up to 1. Alright? So that's fairly straightforward. Alright. These probabilities we call scenario is the outcome. Scenario analysis is the assignment for each outcome of probability. Now the question is the set of probabilities.
There is distribution.
Probability distribution, yes. So you have a probability distribution. So probability distribution. And sometimes, as the textbook says, the probability distribution of the HPRs, the holding period returns. In other words, if you're going to be buying a house for 3 years, you can say, well, we bought it for 100,000. In the bad case scenario, it's going to rise to 110. In the realistically, for 3 years, it will rise to 120. But in the optimistic case, it will rise to 130. And we're now back to your question from the first lecture. Here, the risk or the bad outcome is actually to rise from 100,000 to 110. So, risk does not mean loss. Okay? Risk doesn't mean loss. Risk means, in this particular case, outcomes, probability of outcomes. Risk means that the outcome is relatively unfavorable. Risk means unfavorable, but doesn't mean loss. Alright? Remember this? So, what's next? Next concept is that of expected return. So, we just say that the expected return is simply, and this is actually definition. This is definition from mathematics. The expected return is the return in each outcome weighted by its probability. So it becomes, let's call it R1, which is the probability of, which is the return in outcome A. Well, let's do this, my mistake. Let's do this RA is the return in outcome A. And then you use, this will be, probabilities usually have the letter P. So in this particular case, I say PA, which is the probability of outcome A, plus RB, probability B, okay? Plus RC, probability C. Let's wipe this off. And then we say plus dot 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 plus R. My last outcome is Y. Probability of Y. Question?
P is the probability, but what's R?
R is the return. So R is the standard letter in finance for the return. So RA represents the return for outcome A. RB is the return for outcome B. So we take the first return by its weight or probability. Again, R represents the return and P represents probability, but the probability itself is the same thing as weight. You studied most of this stuff, right? Yeah. Alright, so we move on to the next thing. The next thing is expected return. Okay, so this is the same thing. And let's see what else we have here. So now I can just do the following. Again, this is just a definition of summation. We can sum over R. I missed outcome A all the way to outcome Y or Z, whichever the outcome is. Alright guys, excitement is over. So, now we get to the next concept of surprise return. So the next concept is surprise return. And surprise return is simply the outcome minus the expected return. In other words, the surprise return is the actual deviation away from the expected return. So, if we expected 7%, but in reality we got 9, the surprise return is plus 2. But if we got minus 2 as a return, then minus, what is it? 7 minus 2, the surprise return is minus 9. Alright, so that's the surprise return. The next concept is that of...
Excuse me, sir, you said 7 minus 2?
Yes, so we expected 7, but we got minus 2. So it becomes minus 2, minus 7, becomes minus 9. Alright, so variance is one measure of the overall distribution, and sometimes we call this dispersion. Of returns around the mean. In other words, now we begin to draw some distributions. You may have a distribution like this, or you may have a distribution like, well, I didn't do it really nice. It should have been going a whole lot higher, right? And the variance simply says how close is, or the expected is, sorry, it would be the actual distributions around the expected. So, what is the variance? Variance, they usually use sigma squared, right? Sigma squared is what they use. So, what is sigma squared defined as? Is return in case 1. Alright, so this is the first return multiplied by the probability, right? Oops, it's actually probability of the first return minus the expected return, right? So this is the first deviation. Deviation we have by probability. Now what do? They square it, right?
The first one is the actual, right?
Yes, this is the first one is the, no, this is the first return minus the expected return. So this is the deviation of the first outcome.
So actual minus expected.
We're not saying actual. We have R1, R2, R3. This is not the actual. So you have, let's say, only 4 outcomes. You have outcome A, outcome B, C, and D. So these are the 4, suppose these are the 4 possible outcomes. Neither A, nor B, nor C, nor D is the actual outcome. All we're going to be saying is that you take the return of A and you subtract from it the expected return. In other words, you take the surprise return, you take the surprise return, then you square it to take a normalization with the sign, and then you take the probability of A, okay? And then you use the same story, the return for B, and then again the surprise return, and then we square it again, and then we wait for the probability of B, plus is going to be RC minus expected return, again squared,
times
probability of C. And you simply sum over these. Now, in statistics, you would usually do a division. If you have 5 outcomes, you actually divide by 5, right? Well, this particular case, because I already used the probability will be 1/5 of this, 1/5 of this, 1/5 of this, if we have 5 outcomes, right? So the probability already takes care of this averaging process or this weighting process. So in this particular case, this is what the sigma will be. Alright? So that will be the variation. And now what you have is the next concept of standard deviation. So what the variance does, it says, okay, let's try to find out what are the surprise returns and give them their proper weighting. If the surprise returns are small, with small probabilities, the variance will be small. It's that simple. If the surprise returns are large and their probabilities are large, the variance will be relatively large. So the variance essentially measures the size of the surprise returns, and the size is actually squared. When you square it, this simply means that you provide more weight to the larger surprise returns, and then you still give it its proper probability weighting. So all you do is some sort of normalizing the surprise returns. Alright, that's what it is. So the standard deviation is simply yet another normalization. The normalization is because we were squaring the surprise returns with their weights. Now what we'll have to do is take a square root of these squares to renormalize back.
Square root of the variance. Square root of the variance.
So we take the square root of the variance. So we are renormalizing back. Because if this is 5%, so for example, this is 5%, we work in percentages, and this has 0.1, and this is 5%, and this is again 0.1, and this is 5%. 5% squared will give you 25%. So the first will be instead of 5, 25. The second will be instead of 5, 25. The third will be instead of 5, 25. So all of them, when you raise from 5 to 25, the end result will be, on average, 25. Well, 25 is not the real measure. It is the square of the measure. So you re-weight them according to their weights, and then take the square root to normalize back the 25 to 5.
When we do it from the first place, we don't raise it to the second power from the first place.
Where you mean here?
Yeah.
We raise it to the second power.
No, we don't.
Huh?
If we don't raise it to the second power.
If we don't raise it to the second power, you get a different measure which is recognized but is not widely used. Then you could use a different, and sometimes they call it like this, sigma. They call it like this. This stands for modulus. Modulus. You say PA, and then you have RA minus expected return. But you have to use the modulus.
Okay.
You have to use it. So to be positive. And then use PB, and again, RB minus expected return. So you continue to use the modulus. So you take the surprise return, but you take only the modulus.
So you mean modulus absolute value?
Yes, the same as absolute value. So you always take the absolute value. So the first one will be plus 3. The second one, if it's minus 2, you still take 2. But this measure has many disadvantages. It has too many disadvantages. So the preferred procedure is to square and then take the square root. So again, it's mathematics, it's very complicated. Probably you should have studied why this is an alternative but poorer measure than the standard deviation. Alright? Essentially, one of the ideas for the standard deviation is that it pays more attention to the extreme outcomes. It pays more attention to the extreme outcomes. Because if this is 10% the surprise outcome, which is a very extreme outcome, 10% multiplied by or squared becomes 100. So suddenly it provides a lot more weighting to those extreme outcomes. And this is also how we think in real life. If you expect 10% return, whether it was 9 or 11, is no big deal. But if it's 10%, whether it's 0 or 20, there's a world of difference. In other words, even psychologically, we really pay attention to the big surprises, to the significant surprises, and we pay more attention to the significant surprises than to the minor ones. In other words, the minor don't matter, and this is exactly what this formula does. Alright, standard deviation, let's see what else we have. Well, the next concept to consider is risk aversion.
You accept risk.
Hmm?
You accept risk. There is
Alright, let's do now risk.
No, avoiding risk, right?
Yes, risk aversion, that's how it's called, risk aversion. Simply means the reluctance of investors to accept risk. It's simple as that. The opposite, sometimes they call it risk loving. This is the willingness and desire to take risk. Well, for these, we have a very special name, right? Las Vegas? Gamblers, alright. So, those people that love to take risk, we simply call gamblers. And the process of assuming risk, again, for the sake of risk, we call gambling. So the difference between gambling and investing is that in investing, when you assume risk, you get compensated for it. And in gambling, for the assumption of risk, you do not get compensated. So that's the difference. So risk aversion, again, you have to understand, is in finance, in economics, an assumption. It is inherent in human nature. Humans, we just like not to assume risk. So this is not something which is proven. This is not something which is derived. We just take it for granted. In other words, when people do real investing, they just don't like to gamble with their money. In other words, when people assume risk, they like to be compensated for it. From this assumption follows this shockingly simple result in finance, that shockingly simple result or outcome, that higher risk, and again, we put in here on the one side investments in the investment world, on the other one is risk aversion. Due to risk aversion means higher return. But it turns out that in finance, what we actually need is higher expected return. In other words, higher risk must be compensated. Simple as that. And this is probably, well, not probably, this is effectively the core of portfolio theory. The core of portfolio theory is that higher risk must necessarily result in higher expected returns. Alright, so what we have now is a number of concepts. The first one is the risk-free rate, and sometimes we'll just say rate of return. And the risk-free rate of return is simply the return or the rate of return which you can get for assuming no risk. Usually is associated with government securities in general. They could be T-bills, but it could be T-notes, it could be T-bonds. In other words, with government securities which have no risk. Of course, government securities do have, and especially today, tremendous risk. So, you have no risk, but that's actually false. You have no nominal risk. Nominal risk. No nominal risk. What you have to remember once and for the rest of your investing life, that for every single investment, there always exists so-called inflation risk.
Sir? In the risk-free rate, there is no nominal risk. In the risk-free rate?
Yes, in the risk-free, there is no nominal risk, but there is always, nevertheless, inflation risk. So, it is one of the classic manipulations when they tell that the government securities bear no risk. No, this is false. Government securities always carry with them inflation risk.
Doesn't the rate, you get the coupon rate or whatever, cover the inflation risk?
No, it doesn't cover the inflation risk. The coupon that you get is simply the nominal return. The coupon itself is in nominal terms. So the coupon is 5%, you simply get a 5% return. Simple as that. The 5% nominal return. You still get inflation risk. Well, there is actually government security, so-called TIPS. Have you heard and started the TIPS? TIPS are inflation-protected treasuries. So, this is a government security which protects you against inflation. What's the trick with TIPS? The trick with TIPS is that they use a measure of inflation called CPI. And now they say that with TIPS you have no risk whatsoever, because you have no nominal risk, number one, and number two, you have no inflation risk. But
CPI is not
CPI is not the true measure. So now you get into the problem of measurement risk. So suddenly you're not running the standard inflation risk, but you're running the risk that the government will underreport inflation. Well, is this risk realistic? Of course, it happens all the time. The government consistently has been underreporting inflation for decades. It just underestimates. So, risk-free. So, now we get to the concept of risk premium. And risk premium is simply the
more risk there is, the more return I expect.
The more risk, the more return. But again, what is the risk premium? You're still not saying, the more risk, the more return. All you did was just repeat this. More risk, more return. You still didn't say what is a risk premium. And the risk premium is actually this, is the expected return. Is the expected return minus the risk-free rate. Alright, so notice that the surprise return is what you actually got, the deviation. What the risk premium represents is the expected. So the risk premium is the expected. And let's see what else we have. We have the other concept of excess. So the excess return is simply the actual return, actual actual return minus the, yes, the risk-free rate, minus the risk-free rate. So the excess return is what you actually got above the risk-free rate. And the risk premium is the average that you expect to get. Alright, so sometimes in finance, let's wipe this off. Sometimes in finance, yeah? Well, we take 5 more minutes to finish the section. We started 5 minutes late, so we take 5 more minutes. If you want to go, feel free to go. So, in finance, we have this very common phrase, a so-called risk and reward. Alright? So, the idea of risk is the standard distribution of returns. So, this will be for an asset X. And for the reward, typically we use the risk premium. Risk premium. Alright? So essentially, the more risk, the higher the risk premium. Alright? That's fairly standard. So the reward represents the excess return, which is above and beyond the risk-free. And we say excess expected return. And if we're expected, we're at the risk premium. So let's see what else we have. Risk aversion, we said this, okay.
Excuse me.
So the next, okay.
What's the difference between reward and retail?
Well, notice the reward has no particular meaning in finance. Reward has no meaning in finance. Reward is how people call it. They call it reward. They just call it the risk reward. This is in newspapers, what journalists use. This is on TV, what again journalists use. They just use the word reward, but reward has no meaning in finance. It is meaningless. It just means something you get. Alright, that's what reward is. So in this particular case, reward, and now I emphasize, in the context of portfolio theory, means risk premium. It's the same. That's what I'm explaining. I'm explaining that it has no meaning, but I explain that this is how it is usually used by journalists, professors on TV, and whatnot. Sometimes they'll just say, well, the risk-reward ratio is unfavorable today. In other words, you're getting or assuming too much risk and are compensated with too little risk premium. So that's what they mean. Sometimes they say the risk-reward ratio is very favorable. For example, right now they're saying that today, November 1st, oil is what, like $65, $6? The risk-reward ratio for oil investors is extremely favorable, meaning the risk on the downside is relatively low, and the potential reward, in this particular case on the upside, is relatively high. So, right now the risk-reward ratio is fair. And this is just a usage. This is just a usage, but I'm explaining when they say something, what do they really mean? Alright? So this particular case is the ratio of risk to return. As an investor, you always want to get the lowest possible risk-return ratio, which is the same. You want to get as much return as possible for a given amount of risk. Is this clarifying? Alright, we have still very few things to finish. Well, the next thing is fairly straightforward. Stocks are risky. Actually, in the real world, all investments are risky, including government bonds and including TIPS, Treasury, inflation protection protected securities. So this simply means that the risk premium is always strictly positive. Always positive. Okay, let's see what else we have. We have a measurement, and we're done. That's it. So we are done up to 5.2. We'll finish off the chapter 5 next time and continue with 6. All right?